Good day, everyone. This is our discussions involving dividend policy. We are going to divide the entire chapter into two parts, just like the usual. And this is the first part for dividend policy. Without further ado, let's begin. From our source, so this is about how companies would be issuing dividends, declaring and distributing dividends, then what are the issues surrounding such or them. Now we have to know the basics about dividends. There are actually relevant dates to remember. First is announcement date. Some would be actually calling this one as the date of declaration. So announcement or declaration. Then it is on this date, of course, or announces the dividend, meaning the amount, then to determine the persons or shareholders to whom the dividend shall be given, and the dates for payment. So I'm already saying, or I already said about the date of record and the date of or for payment. Then we have to take note that normally in terms of accounting and in terms of entries, the announcement date would be the time that we are going to get a portion from our retained earnings or accumulated profits and losses. Then the date of record will be with no entry, but this time we have to know who really are the outstanding shareholders who would really receive or who should receive dividends. Then X dividend date, this is actually the date wherein if ever a person or let's say an investor, certain investor would be interested to buy stocks, then the shares that they are buying already lapsed the accumulation of dividends, meaning that the shares that are bought no longer have dividends with them. The opposite of X dividend is dividend on. So in dividend on, that means that the shares bought still have dividends or actually have dividends with them. Actually, for dividend on, normally, if ever, for example, you buy the shares or an investor would buy the shares in between the announcement date and the date of record. But if it is after the date of record or in between date of record and the payment or disbursement date, normally that is X dividend. Okay, so good point. The persons who buy the stock before X dividend date will still receive the current dividend, of course. Clearly, X dividend is without dividends anymore. All right, so we have here an example that Microsoft Corporation made a payout cash dividend for the first time ever in January 2003. The annual dividend is $0.08 per share. Earnings per share EPS is $0.92 for 2003, in which the payout ratio then is 8.7%. So the question is, how do you get the payout ratio? That is simply the dividends divided by the earnings. It's called payout ratio, dividend payout ratio to be more specific, because to pay dividends, you will get out of the earnings or profits from the business. So that's how we got that, 0.08 divided by 0.92. In September 2003, Microsoft announced that fiscal year 2004 dividends per share would be doubled to $0.16 per share. Oh, in just like a matter of 9 months or 8 months to 9 months. Then 10 months later, Microsoft shocked investors by announcing plans to pay a one-time $32 billion special cash dividend and also to once again double the annual dividend payment. So we would say by then there's a story behind that. Microsoft was very successful. By 2007, annual dividend payment had risen to $0.40 per share and its payout ratio was 29%. Oh, so from like 0.08 to 0.16 to 0.40, and then ratio for payout is 8.7, now 29%. Of course, that's 2007. Now, what would be the maximum amount that a firm can pay in cash dividends? Under the Philippines rulings or laws, the Corporation Code of the Philippines, we have the so-called trust fund doctrine, wherein not all of the equity or capital of a certain corporation can be issued in the form of dividends. It is because that is to impair the rights of the creditors. In order to protect the rights of the creditors, a portion of the capital should remain, and you call that the legal capital. So legal capital is defined as the par value of the common stock, all shares of the corporations issued, including the preferred stock or preference shares. And then what can be paid out would be just the sum of 200,000 and 140,000 in a form of dividends without impairing the capital. However, we can even, for example, appropriate or set aside or earmark a portion of retained earnings as for other purposes. So in states where a firm's capital includes all paid-in capital, the firm can pay out only $140,000 in cash dividends. So this is in United States. The first concept, this one. So this is the legal capital. This is what is actually applied in the Philippines. Next, more dividend fundamentals. These are now on the types of dividends. So if we pay, for example, cash, really, so cash in bank, not literally like the legal tender cash, actual, which can be regular or special, and then there can be differences. The types of dividend policies could be, there could be constant payout ratio, or the payments, the amounts are constant. Then there can be low, regular, and extra dividend. For the stock dividends and splits, so dividends can be in the form also of additional issuances of shares. Stock splits in effect, on another hand, would be that we are like dividing more shares, or we are changing the number of shares into more, but then the par value would be lesser, and overall the total value of the shares of the corporation would be the same. Then stock repurchases, this is the case when we buy our previously issued shares on the market. So tender offer to shareholders, and there can also be private negotiation or green mail. For types of dividends, especially the policies, we've said that the constant payout ratio will be, well, payout ratio is dividend divided by earnings per share. So if we say constant, that's the same all throughout. Nominal payments will be the amount, again, of the dividends to be issued. So this is based on fixed dollar dividend. Firms often increase the regular dividend once a proven increase in earnings has occurred. Then that's a possibility. Firms almost never cut dividends unless they face a true crisis. All right. Although if I'm going to ask you, what do you want, like constant? Well, it seems that we want like the variable also, so that if there are higher profits for the corporations in which we invested, we would be getting more dividends. For low, regular, and extra dividend, these are supplementary dividends given. Additional cash dividend when warranted by earnings. Stock dividends, actually, this is just a review from your corporation accounting discussions. Stock in the form of dividends is stock dividend. This is also based on the preemptive right, or right of preemption of shareholders, wherein before we are going to issue more shares, we have to offer them to our existing shareholders or owners so that they can protect their equity interests in the corporation. Stock splits, as said, stock splits would really increase the number of shares, but the par value or stock prices of the shares would decrease by that, so that the overall value of the shares in which we apply the stock splits would be the same. Then in this case, shareholders receiving stock dividends would maintain a constant proportional share in the firm's equity. That is if, like, of course, all would be given. We are assuming that. Then neutral, because we're talking about same proportional interest. Stock splits we have already mentioned, like 2-for-1. So this would mean that, for example, if the number of shares was 20 million and you want 2-for-1 split, so that would be becoming 20 million times 2, 40 million. And then for the par value, let's say the par value was 50. With a 2-for-1 split, it will become 25. Stock splits affect firms' shares similar to stock dividend effects, of course. So again, I've already discussed that in the previous slide. It will not increase any value for shareholders, and it would not also have impact on the capital structure. Overall, it's the same. Now, stock splits for General Electric, this is like a big corporation in US versus Berkshire Hathaway. So most established US public companies routinely split their shares to keep the price within a perceived optimal range. So they want the values of their shares to be like the same. Now for this particular time or overall value, by the way, of shares, because we're talking about stock split. So at the end of 1935, stock price was this amount in dollars. Then in 2007, this amount. So had G not split its stock repeatedly over the past 70 years, the price will have to be like very big. So the price per share. So this is the impact of split. So it decreases the value of shares. Then the price of the most famous company that refuses to split, okay, expect to be very big, $110,700 per share. Oh my, like who can afford that? Next, share repurchases. This is the time wherein the shares that are previously issued will be acquired. We call them actually treasury shares if in Philippine setting. So the rising importance of share repurchases implies that they enhance shareholder value, perhaps because they have traditionally been a tax-advantaged method of distributing cash. This is like a point of view in US though. But then if, for example, this is obtaining shares to be used in acquisitions, well, that would increase like your number of shares for a corporation, if not like treasury shares, just buying on the part of the corporation buying shares from existing shareholders. So of course that would not really have increase in the value of like the shareholders equity or the value for shareholders. But then if we acquire shares in acquisitions, having shares available for employee stock option plans, so meaning more shares are issued to employees. So of course that would increase value for shareholders. For retiring shares, well, that wouldn't be like treasury shares. Then share repurchases send a positive signal to investors in the marketplace that management believes the stock is undervalued. So there has to be more value of the shares. And then this would reduce the number of shares outstanding and raising earnings per share, because to get earnings per share, that is basically the earnings available for common shareholders divided by the number of shares outstanding for the common shareholders. Now we can see here that the adjusted earnings in blue increased. And then, although there are fluctuations along the way, but we can see that the line is moving up. And then this will have to follow with the payouts, the dividends, and there's like a dramatic ups and downs for the repurchases. By the way, those are from 1980 to 2005. Then what about for tax relief? In the tax relief, meaning there's been some programs in the US for people there, especially the shareholders, those who are engaged in investments, to be able to get a sort of support and a breathing session for them not to be really burdened about taxation. So it has been observed that there has been a lot of share repurchases in the last 20 years, thereby increasing, of course, the earnings per share. What were the reasons? Cash dividends taxed as ordinary income for the shareholders. So this is like from there, because in Philippines, any dividends are treated as final passive income tax. Okay, so anyway, it's an ordinary income for the shareholders, so part of their like regular income. And then the capital gains on the repurchases were taxed. And this reduced the tax rates on cash dividends received by individuals. And also, allow me to minimize this. Incentive for share purchases has been reduced though. This is happening again in the US. This is the flow. It's like there's really a dramatic but going downward flow of fractions of publicly traded US firms, meaning those in which their businesses are registered in Securities and Exchange Commission and having the licenses to issue shares, and their shares are actively traded in the market or stock market. So it's going down. Like in terms of are they paying dividends? It's going down. Perhaps they want like management or shareholders would like, or both though, to have their respective values of investments to grow and grow or grow more. Then this is also for another situation, fractions paying cash dividends. So it's going down like the New York Stock Exchange and Amex and NASDAQ. Patterns observed in dividend policies worldwide. So there are some distinct national patterns. If we compare the companies in common law countries, so meaning there's not like really, let's just say, observed law that is well established. So we have the common law there. So just a sort of FYI or tidbit of information, we just need to compare like a bit common law versus civil law. If you say common law, this would mean that the law or laws of the countries, as what I've said, not well established because actually these would be unwritten laws that are just based on the judicial proceedings and the judicial precedents, meaning based on what happened in courts, they are actually being applied now on a certain country or state or nation. So it's more on unwritten. Whereas for civil law, it's based really on codified, on written laws, and our analysis and judgments would be based on what's written. So that's the difference between the two. US companies now nearer to global average because it has been found out that more common law countries have higher payouts than the civil law countries. Okay, so here's an example. The common law median is higher than civil law as well as the dividends over sales. And we can see that here. So dividends to earnings, this is the dividend payout ratio. Civil law is this one, and then common law is this one. So common law is really higher than civil law. Patterns observed in dividends policies worldwide as continued. There are pronounced industry patterns. So profitable firms in mature industries, especially those who are already in the saturation of their respective businesses, tend to pay out much larger fractions of their earnings than those who are actually, let's just say, still growing companies. So they might be like just keeping and keeping their monies because that is to be able to really maintain growth. Now, these patterns are the same worldwide. Another thing is that asset-rich, regulated, and slow-growing companies tend to have high dividend payout ratios too. It's because they're asset-rich and they're much regulated. Almost all firms maintain constant nominal dividend payments per share. Take note, this is almost all, so it's not like perfectly constant for significant periods of time. So it's much longer. If you would like to see like there has been constant like amount or percentage. Then these are the dividend payout ratios for selected US industries. Well, for this one, we can notice that for simple, really like the highest would be the basic chemicals as well as the weighted average. And then for biotechnology, zero. Semiconductors, above the zero would be the lowest though, both simple and weighted. Then we have for selected US corporations in 2007, their respective dividend ratios. Lessons would be like these would tell stories like if we have lower dividend payout, this would mean that the company doesn't want to really provide more returns to the shareholders and so on. And perhaps there are reasons to that. So we cannot like judge that the management wouldn't want, they're just keeping the monies for themselves. No, no. So we're just thinking that perhaps there's a greater purpose about keeping the monies yet for the organization. Okay, so this is the first part of our discussions about dividend policy. Thank you very much and God bless us all.